As the U.S. Federal Reserve continues to raise rates to curb inflation, stock prices may remain subdued while prices of goods and services continue to skyrocket. Stock prices typically decline while interest rates are high due to limited cash in the financial system. Creating multiple sources of income offsets the decline of our cash purchasing power and potentially alleviates the effects of inflation in our daily lives. A great investment plan may include looking into high dividend yield stocks. Historically, dividend stocks are less volatile and have outperformed the S&P 500. This is because dividend stocks offer two types of income: consistent dividend income and stock price growth, and their total return can definitely add up over time. While the markets are still down, we believe now is the best time to seek the best bargains that are currently out there, and we're here to help you find them. We do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. That being said, here are the 5 best high-yield dividend stocks to buy right now. If you like this video, make sure to destroy the like and subscribe buttons so you won't miss any of our future content. Make sure to stay till the end, as our last stock pick is our favorite, and we think you'll like it too. Now let's get right to the video. First off, we have Philip Morris International Inc. Philip Morris International Inc. is a leading global tobacco giant. It aims to create a smoke-free future and is long-term expanding its portfolio to include goods unrelated to tobacco and nicotine. The majority of the company's current product offerings are cigarettes and smoke-free items, including heat-not-burn, vapor, and oral nicotine solutions. At the start of 2020, Philip Morris's stock was trading at around $88 a share, yet this sharply crashed to $57 when COVID hit, a 36% decline from its peak. Fast forward to today, its stock has recovered well above its pre-pandemic high and trades at around $105 a share. Due to its high dividend yield, Philip Morris is a true defensive stock that fares well even in the midst of the current market downturn. Looking into its acquisition front, Philip Morris recently acquired 90% ownership of Swedish Match, a Swedish multinational tobacco company headquartered in Stockholm. The company operates in the United States, the Dominican Republic, Brazil, the Netherlands, and the Philippines, and produces snus, nicotine pouches, moist snuff, tobacco and nicotine-free pouch products, chewing tobacco, chew bags, tobacco bits, cigars, matches, and lighters. According to PMI Chief Executive Jacek Olczak, we are delighted to have obtained over 90% ownership of Swedish Match, allowing us to initiate a minority redemption process to acquire the remaining shares outstanding and request the delisting of the company from the stock market. Buying Swedish Match with its popular wet snuff snus products and tobacco-free nicotine Zyn pouches will aid Philip Morris in its stated ambition to move away from the health-harming cigarettes and eventually become a smoke-free company. This transaction marks a major milestone in accelerating our shared objective of a smoke-free future, Olczak said. Looking into the numbers, Philip Morris has booked an average of $30 billion of revenue over the course of 10 years, from $31 billion in 2012 and 2021. What's interesting, though, is its operating margin, which averaged a whopping 41.4% over the same period, from 44.4% in 2012 to 50% in 2021. What's more, its return on invested capital averaged 38.4% over the past decade, from 45.4% in 2012 to 45% in 2021. Evidently, Philip Morris surely has a competitive advantage in their own sector. At its present share price of $85 and conservative earnings per share predictions of 3% annually, our model projects that Philip Morris's stock will have annual returns of 9.2% over the next 5 years. Coming up next is a company called VF Corp. VF Corporation is a global manufacturer of footwear and products for active lifestyles. The company owns a wide variety of brands in the sectors of jeanswear, outerwear, packs, footwear, sportswear, and work gear. VF provides goods that are sold to customers who buy at specialty shops, upscale traditional department stores, international chains, and mass merchants. VF controls 55% of the U.S. backpack market with familiar brands such as JanSport, Eastpak, Timberland, and North Face. Prior to the crash of March 2020, its stock price was trading at the range of $77 and $99 a share. This sharply dropped to $46 a share, a 55% crash from its previous peak due to the markets anticipating low demand in apparel due to prolonged lockdowns. Though this presented a window of opportunity to accumulate VFC stock at a discount, its current price is trading well below these levels. Might sound like a bad idea to buy, but a company with a strong dividend yield of 6% per year might be worth a shot. As the adage goes, the best time to buy is when there's blood in the streets. Looking into its ESG initiatives, VF Corporation initiated the largest renewable energy tax equity investment in the footwear and apparel industry in July 2022. 4 utility-scale solar projects in South Carolina will be developed with the help of this investment, which should be finished within the next 6 months. These projects are projected to produce 47,000 MWh of renewable energy annually, or around 23% of VF's global electricity use in 2021. According to Jeannie Wren Malone, VF's Vice President of Global Sustainability, VF's recent tax equity investment aligns with our commitment to address climate change and increase our use of renewable energy. We are excited that this investment is good for business and the planet. We hope investments such as this and our industry-first green bond will inspire other major companies within our sector and beyond to make similar financial investments for the betterment of people and our planet. VF Corp has booked an average of $11 billion in revenue over the past 10 years, from $11 billion in 2013 to $12 billion in 2022. They have maintained their operating margin at an average of 12.9% over this same period, from 13.5% in 2013 to 13.8% in 2022. What's interesting, though, is looking into their return on invested capital. Their ROIC has averaged 13.6% over the past decade, from 16% in 2013 to 15.6% in 2022. At its present share price of $29 and conservative earnings per share predictions of 10% annually, our model projects that VF Corp stock will have annual returns of 19.8% over the next 5 years. Now let's look into a high-yielding dividend stock in the banking sector, and one of our favorites is Citigroup Inc. Citigroup Inc. is a diversified financial services holding company that offers both consumer and corporate clients a wide range of financial services. Investment banking, retail brokerage, corporate banking, and cash management products and services are among the services provided by the company. Citigroup offers services to clients all around the world. Before the pandemic started back in 2020, Citi's stock was trading at around $82 a share. This sharply dropped to $33, a decline of roughly 59% from its previous peak as investors all around the world began liquidating stocks of companies they think will take a great hit during global lockdowns. This presented a window of opportunity to accumulate this banking giant's stock at bargain prices. Shortly thereafter, the stock managed to climb back to its pre-pandemic high in June of 2021. Yet, due to the current macroeconomic factors at play, the stock trades at a 40% below its previous high, an attractive entry point to accumulate a stock that yields 4.20% dividends annually. Speaking of dividends, several large U.S. banks are expected to increase dividends in 2023, even with the rise in capital requirements. According to forecasting data from S&P Global Market Intelligence, 16 of the 17 public banks with more than $100 billion in total assets as of September 30th are anticipated to increase dividends in 2019. If they do not deplete their stress capital buffers, one of the elements of banks' capital requirements, banks are free to pay dividends and purchase back shares. However, these requirements have been increasing as a result of the losses anticipated by the significant bank stress tests conducted by the Federal Reserve in 2022, which revealed a greater decrease in capital than in 2021. It is expected that the dividends paid by the 3 Big Four U.S. banks, JP Morgan Chase & Co., Bank of America Corp., and Citigroup Inc. will increase by 5.0%, 14.0%, and 11.8% to $4.20, 98 cents, and $2.28 respectively. In the third quarter, Citigroup returned over $1 billion to its shareholders through common dividends, while repurchases are still on hold. We will keep evaluating that decision on a quarterly basis as due to increasing regulatory requirements, we build our CET1 ratio to 13% or so by mid-next year, CEO Jane Fraser said on the company's earnings call. Citigroup has booked an average of $74 billion of revenue over the past 10 years, from $70 billion in 2012 to $72 billion in 2021. Its operating margin significantly increased from 10.9% in 2012 to 30.5% in 2021. That's an average of 16.9% over the past decade. Its return on invested capital averaged 2.6% over the same period, from 1.5% in 2012 to 4.5% in 2021. At its present share price of $47 and conservative earnings per share predictions of 5% annually, our model projects that Citigroup's stock will have annual returns of 12.6% over the next 5 years. Coming up next is a company called Total Energies, TTE. One of the biggest publicly traded oil and gas corporations in the world, Total Energies SE has more than 100,000 employees working in more than 130 nations. It is ranked among the top 2,000 public corporations in the world, according to Forbes. Total Energies operates through 3 segments: exploration and production operations, refining and petrochemicals operations, and ship and market. The exploration and production operations segment focuses on the exploration and production of oil and gas, renewable energies, solar and wind energy, and bioenergies, renewable low-carbon resources. The refining and petrochemicals operations segment includes refining and petrochemicals, electricity, and specialty chemicals. The ship and market segment includes operations of trading and shipping, providing services and products such as fuels, lubricants, bitumen, natural gas, special fluids, and fuel additives or power and solar photovoltaic solutions. Prior to March 2020, its stock price was trading between $48 and $55, yet had crashed to $22 at the height of the market fear brought about by the COVID-19 outbreak. Since then, its stock price has slowly recovered back to its peak levels. In fact, its current stock price now is exactly where it was before the crash of 2020. I get it, there's a bit of FOMO in the air, but don't fret since we're still seeing more upside with this stock. Following a settlement last month that ended a long-running maritime border dispute between Lebanon and Israel, French oil firm Total Energies announced it would shortly begin gas exploration activities in the Mediterranean Sea off the coast of Lebanon. The settlement was mediated by the United States. A framework agreement was reached with Israel, opening the possibility of exploration in the so-called Kana field, according to a statement released on Tuesday by Total Energies and its partner, Italian company Eni. The Maritime Boundary Agreement has been praised as historic and advantageous for both parties. It is the first substantial diplomatic achievement between the two nations in a long time. While this presents endless opportunities for the future of the company, let's dig into the numbers to see if this stock is worth every penny. Total's revenue for the past 10 years has averaged $176 billion, which has gone down from $234 billion in 2012 to $185 billion in 2021. Yet its operating margin has increased from 19% to 21% with an average of 16.6% over the same period. Return on capital invested has averaged 8.4% annually over the past decade. Its average dividend yield for the year is 6.2% and is steady. Now, this stock is worth picking if a strong dividend yield is what you're looking for. Based on our model, Total is still poised to deliver around 13.5% annual returns over the next 5 years. Last but definitely not least is British American Tobacco Industries. British American Tobacco is a multinational corporation based in the UK that produces and markets tobacco, cigarettes, and other goods containing nicotine. The business was founded in 1902 and it has its headquarters in London, England. Based on net sales, it is the biggest tobacco firm in the world as of 2019. Dunhill, Kent, Lucky Strike, Pall Mall, and Rothmans are just a few of the cigarette brands owned by them, which conduct business in almost 180 nations. Additionally, its brands include Vype, Vuse, and Glow. Before the beginning of global lockdowns in March 2020, its stock was trading at around $45 a share. This sharply dropped 40% down to $28 a share as investors panic sold worldwide. Though its stock managed to recover from these lows, its current price is trading at a 7% discount from pre-pandemic levels. This could be a good entry point as dividend stocks typically hold their value in the middle of a bear market. Looking into its investment front, BAT Group recently announced an investment in Charlotte's Web Holdings, Inc., a company based in Colorado, USA, and is traded on the Toronto Stock Exchange. Charlotte's Web Holdings is the leading U.S. brand for cutting-edge hemp extract health goods. They offer tinctures, pills, chews, and topicals as product formats. Its chief growth officer, Kingsley Wheaton, said, "The appeal of Charlotte's Web is clear to us. A wide portfolio of high-quality products, strong brand equity, an extensive retail presence, and robust B2C e-commerce platform, serving a loyal U.S. consumer base and a track record of in-depth scientific research. Our investment in Charlotte's Web represents another step for BAT in our exploration beyond tobacco and nicotine as we continue to build a strong foundation to deliver a better tomorrow." Jacques Tortorelli, CEO of Charlotte's Web, remarked that this investment will provide Charlotte's Web with funding that they anticipate will help unlock deeper and broader research and development that is key to Charlotte's continued innovation, global footprint, and the advancement of its intellectual property portfolio. Digging deeper into British American Tobacco's numbers, their revenue has grown from $24 billion in 2012 to $35 billion in 2021, averaging $27 billion per annum over the past decade. What's interesting, though, is looking into their profit margins. For the past 10 years, their operating margin has averaged 36.3%, from 35.8% in 2012 to 39.9% in 2021. Though their return on invested capital has tightened from 20.5% in 2012 to 6.4% in 2021 due to some headwinds, they still average 17.4% over the course of 10 years. At its present share price of $38 and conservative earnings per share predictions of 3% annually, our model projects that British American Tobacco's stock will have annual returns of 10.4% over the next 5 years. So there you have it, folks. Those are our 5 best high dividend yield stocks to buy right now. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing rest of your day.